Imagine waking up to a world where the wealth you've spent a lifetime building simply vanishes. It starts with a whisper, then a cold reality. The morning sun hits the city, but the grand bronze doors of the central bank remain bolted shut. A chilling stillness hangs in the air. A line begins to form. What starts as a few concerned citizens grows into a desperate crowd, their faces etched with growing anxiety and fear. Among them is an older man. His knuckles are white as he tightly grips a thin paper passbook, his only proof of a life's work. Nearby, a shopkeeper checks his phone. A spinning icon mocks him as his digital balance remains frozen, unreachable behind a wall of code. Inside the bank, the truth is even darker. The manager sits in a dimly lit office, staring at a screen that tells a terrifying story. One word begins to circulate through the panicked streets, whispered like a curse: liquidity. The system has run dry. To understand why this happens, we must look back. Long before banks, value was physical, a sack of grain for a sharp tool. But barter was difficult. If you had shoes and needed wheat, but the wheat seller needed a coat, trade simply stopped. We needed a medium, something rare, durable, and divisible. Gold and silver became the anchors of our collective trust. Money isn't just paper or metal. It is a shared language. It is a way for us to agree on the value of our labor. But modern banking changed the rules. When you deposit money, the bank doesn't keep it all. They keep a tiny fraction. The rest is lent out, creating a glowing stream of credit that flows into the economy, building houses and starting businesses. This is the engine of growth, but it is built on a fragile foundation. The absolute confidence that everyone won't withdraw at once. Imagine financial markets as a complex system of pipes. Usually cash flows through them like water, keeping the world moving. But when defaults rise, the water turns to sludge. The flow slows, then stops. The pipes begin to freeze under the pressure. Screens that once glowed green with profit turn a violent red. Then, as the panic peaks, they simply go black. We have seen this before. In Argentina, in the Great Depression, scenes where currency becomes nothing more than litter on the street. When the belief in paper fractures, we return to what is real: food, fuel, and the strength of our local communities. Money will always transform, from shells to gold to digital bits, but human cooperation and true value will always persist. The doors may be closed today, but the value we create together cannot be locked away. The sun will rise on a new system. What survives when money fails is not random. It follows patterns, consistent, repeatable, and deeply tied to human behavior. To understand those patterns, we need to strip the system down to its bare components. Imagine the entire financial world reduced to a whiteboard. At the center, draw 3 circles. The first is trust. The second is liquidity. The third is real value. Everything we call money exists at the intersection of these 3 forces. Now trace how they interact. Trust allows money to be accepted. Liquidity allows money to move. Real value gives money meaning. Remove one, and the system fractures. Remove 2, and it collapses entirely. This is the mechanism, not hidden, but often ignored because it is too simple. Let's walk through it. Start with trust. When you accept a note, you're trusting that someone else will accept it from you tomorrow. This chain gives currency power. Break that chain, and the note becomes just paper. Next, liquidity. Liquidity is not wealth, it is access. A house may be worth millions, but if you cannot sell it when needed, it provides no immediate utility. Cash, by contrast, is highly liquid. But liquidity is fragile. It depends on functioning markets and willing buyers. When those disappear, valuable assets become effectively unusable. Finally, real value. This is the anchor. Food, energy, land, labor, these exist independently of financial systems. Money is simply the tool we use to measure them. When money fails, trust shifts to new forms and liquidity migrates. In every financial collapse, the first instinct is preservation. People move toward assets that are closest to real value because they are reliable. During hyperinflation, cash becomes toxic. Individuals convert it immediately into goods or foreign currencies. This is rational behavior under a broken system. At the same time, new networks of trust emerge. Communities develop credit systems based on reputation rather than institutions. Financial crises are not just economic events. They are reorganizations of trust, and trust is not evenly distributed. In 2008, the catalyst was mortgages, but the real issue was leverage. Institutions built positions larger than their capital could support. This created a feedback loop. Losses led to selling. Selling led to lower prices. The system fed on itself. The recovery process is about reconnection. Central banks restore liquidity, and governments provide guarantees to rebuild trust. Consider modern complexity. ETFs, private equity, cryptocurrencies, each adds capability, but also potential for failure in ways hard to predict. How do you navigate this? Start with one question. Where does the value actually come from? Is it real economic activity or financial engineering? Return to that morning outside the bank. The doors are closed, but the shopkeeper is already accepting digital payments from a different provider. The system is not collapsing, it is being stabilized, but the illusion of permanence has been broken. So what survives when money fails? Not the symbols, but the ability to produce, the capacity to exchange, and the networks of trust. In the end, money doesn't fail all at once. It fractures. And through those fractures, you can see what was real all along.